Good morning, everybody. And now let's proceed to the next chapter, the chapter 2, Managerial Accounting and Cost Concepts. Here's the learning objectives. So, after the studying chapter 2, you should be able to first understand cost classifications used for assigning costs to cost objects, direct costs, and indirect costs. Second, identify and give examples of each of the three basic manufacturing cost categories. Third, understand cost classifications used to prepare financial statements, product costs, and period costs. Fourth, understand cost classifications used to predict cost behavior, includes variable costs, fixed costs, and mixed costs. Fifth, analyze a mixed cost using a scatter graph plot and high-low method. Sixth, prepare income statements for a merchandising company using the traditional and contribution formats. And lastly, understand cost classifications used in making decision includes differential costs, opportunity costs, and sunk costs. And now, may I call on Miss Alder to discuss or report the first topic of this chapter.
Thank you, Mr. Bamboo Montilla. And now let me discuss to you the cost classification for assigning cost to cost objects. Cost objects. Costs are assigned to cost objects for a variety of purposes including pricing, preparing profitability studies, and controlling spending. A cost object is anything for which cost data are desired, including products, customers, jobs, and organizational subunits. For purposes of assigning cost to cost objects, costs are classified as either direct or indirect cost. So what is a direct cost? A direct cost is a price that can be directly tied to the production of specific goods or services. A direct cost can be traced to the cost objects, which can be a service, product, or even department. Direct costs are often variable costs, meaning they fluctuate with production levels such as inventory. Indirect cost. Indirect costs extend beyond the expenses you incur creating a product to include the costs involved with maintaining and running a company. These overhead costs are the ones left over after direct costs have been computed. The materials and supplies needed for a company's day-to-day operations are examples of indirect costs. While these items contribute to the company as a whole, they are not assigned to the creation of anyone's services. Indirect costs include supplies, utilities, office equipment rental, desktop computers and cell phones. Much like direct cost, indirect cost can be both fixed and variable. Fixed indirect costs include things like rent. Variable costs include the fluctuating cost of electricity and gas. Now let's talk about the differences between direct and indirect costs and why is it important. A simple trick to classify payment as direct or indirect cost is that direct cost encompasses the cost involved with creating, developing, and releasing a product. Direct costs include manufacturing supplies, equipment, raw materials, labor costs, and other production costs. Conversely, indirect cost encompasses costs not directly related to the development of your business's products or services. Indirect costs include your utilities, office supplies, office technology, marketing campaigns, accounting and payroll services, employee benefit and perk programs, and lastly, insurance cost. So that would be all for cost classification for assigning cost to cost object. And now, may I call on Miss Elanie?
Thank you, Miss Alder, and now let me discuss about cost classification in manufacturing companies. Manufacturing cost. Most manufacturing companies further separate their manufacturing costs into two direct cost categories: direct materials and direct labor. One direct cost category and manufacturing overhead. Now let me discuss the direct materials. Direct materials. The materials that go into the final product are called raw materials. This term is somewhat misleading because it seems to imply unprocessed natural resources like wood pulp or iron ore. Actually, raw materials refer to any materials that are used in the final product, and the finished product of one company can become the raw materials of another company. For example, the plastic produced by DuPont are raw materials used by Hewlett-Packard in its personal computers. Raw materials may include both direct and indirect materials. Direct materials are those materials that become an integral part of the finished product and whose cost can be conveniently traced to the finished product. This would include, for example, the seat that Airbus purchased from subcontractors to install in its commercial aircraft, and the electronic components that Apple uses in its iPhones. Direct labor. Direct labor consists of labor costs that can be easily traced to individual units of product. Direct labor is sometimes called touch labor because direct labor workers typically touch the product while it is being made. For example of direct labor include assembly line workers at Toyota, carpenters at the home builder KB Home, and also electrician who install equipment of aircraft at Bombardier Learjet. Labor costs that cannot be physically traced to particular products or that can be traced only at great cost and inconvenience are termed indirect labor. Just like indirect materials, indirect labor is treated as part of manufacturing overhead. Indirect labor includes the labor costs of janitors, supervisor, materials handlers, and night security guards. Although the efforts of these workers are essential, it would be either impractical or impossible to accurately trace their cost to specific units of product. Such labor costs are treated as indirect labor. Manufacturing overhead. Manufacturing overhead, the third manufacturing cost category, includes all manufacturing costs except direct materials and direct labor. Manufacturing overhead includes items such as indirect materials, indirect labor, maintenance and repairs of production equipment, and heat and light property taxes, depreciation and insurance on manufacturing facilities. A company also incurs costs for heat and light property taxes, insurance, depreciation, and so forth, associated with its selling and administrative functions, but these costs are not included as part of manufacturing overhead. Only those costs associated with operating the factory are included in manufacturing overhead. Non-manufacturing costs. Non-manufacturing costs are often divided into two categories: selling costs and administrative costs. Selling costs include all costs that are incurred to secure customer orders and get the finished product to the customer. These costs are sometimes called order getting and order filling costs. Examples of selling costs include advertising, shipping, sales, travel, sales commission, sales salary, and cost of finished good warehouse. Selling costs can be either direct or indirect costs. Administrative costs include all costs associated with the general management of an organization rather than with manufacturing or selling. Example of administrative costs include executive compensation, general accounting, secretarial, public relation, and similar costs involved in the overall general administration of the organization as a whole. And Mr. Montilla Bamboo will discuss cost classification for preparing financial statement.
Thank you, Miss Elaine Oy. And now, let's proceed to the next topic of this chapter, which is the cost classifications for preparing financial statements. When preparing a balance sheet and an income statement, companies need to classify their costs as product costs or period costs. Yet, we need to discuss first about the matching principle from financial accounting. Generally, costs are recognized as expenses on the income statement in the period that benefits from the cost. For example, if a company pays for liability insurance in advance for 2 years, the entire amount is not considered an expense of the year in which the payment is made. Instead, one half of the cost would be recognized as an expense each year. The reason is that both years, not just the first year, benefit from the insurance payment. The unexpensed portion of the insurance payment is carried on the balance sheet as an asset called prepaid insurance. So it means that kung unsay ray na gamit maura sab ma-considered as expense while ang kantong waya pa na-incur may gitawag nga prepaid insurance nga mao sa mabutang sa balance sheet. So it's very common. It's not peculiar for us since it's already discussed during our cost accounting subject. Now, the matching principle is based on the accrual concept that costs incurred to generate a particular revenue should be recognized as expenses in the same period that the revenue is recognized. So this means that if a cost is incurred to acquire or make something that will eventually be sold, so then the cost should be recognized as an as an expense only when the sales take place. That is, when the benefits occurs. Such costs are called product costs. Product costs include all costs involved in acquiring or making a product. It also refers as inventoriable costs since product costs are assigned to inventories and are considered assets until the products are sold. At the point of sale, product costs become cost of goods sold on the income statement. That's why we want to emphasize that product costs are not necessarily recorded as expenses on the income statement in the period in which they are incurred. Rather, they are recorded as expenses in the period in which the related products are sold. Period costs. Unequivocally, period costs are all the costs that are not product costs. All selling and administrative expenses are treated as period costs. Example includes sales commissions, advertising, executive salaries, public relations, and the rental costs of administrative offices. Period costs are not included as part of the cost of either purchased or manufactured goods. Instead, period costs are expensed on the income statement in the period in which they are incurred using the usual rules of accrual accounting. In short, period costs are taken directly to the income statement as expenses in the period in which they are incurred. And now from this topic, it tackles also about the prime cost and conversion cost. Two more cost categories are often used in discussions of manufacturing costs. That's our prime cost and conversion cost. Prime cost is the sum of direct materials cost and direct labor cost. On the other hand, conversion cost is the sum of direct labor cost and manufacturing overhead costs. To improve your understanding of these definitions, consider this scenario. a company has reported the following costs and expenses for the most recent month. So here's the following data. So these costs and expenses can be categorized in a number of ways, including product costs, period costs, conversion costs, and prime costs. So in order to solve the product costs, we should add the direct material, direct labor, and manufacturing overhead. On the other hand, to get the period cost, still we need to add the selling expenses and administrative expenses. In conversion costs, simply add the direct labor and manufacturing overhead, while in prime cost, it simply add also the direct material and direct labor. So that's the end of the third topic of this chapter, which there are only three subtopics: the product costs, the period costs, and the prime cost and conversion costs. So in the next topic, let Miss Manager Calagui to discuss about the topic entitled Cost Classifications for Predicting Cost Behavior.